How does the debt ceiling work? How big is the problem? And what are the possible solutions?
In the US, no, Taco?
Let's start with the US.
We think it's a problem, and at this time it can be maybe a little bit bigger problem than previous years, previous times. But first, it is quite a technical situation. That's why we have in front of us a lot of information, a lot of paper, and we will look at this paper today because we want to give you the right information. First, I want to tell you a little bit more about the debt ceiling in the US. At the moment, because it's a fixed amount, in this moment it's 31.4 trillion US dollars. So that means that's the maximum legal limit on the total amount of debt that the federal government can spend. It's the first time, so that's the limit, and now it's crossing, or it already has crossed the limit of that ceiling. Is that the first time? No, it isn't. If you look back until 1960, already 78 times the ceiling has been touched.
Even I remember, I think 10 or 12 times that it's always in the news, no? During working here. Like,
yeah,
watch
because
out.
if they touch the ceiling and they increase the ceiling, it's not a problem. But when they don't increase the ceiling, then there is a problem. And when does it, or I already said it already has been touched the ceiling because that already happened in January, and then you come in an extraordinary measurement time frame, because what will happen then the US Treasury Department, they have of around $500 billion on cash. That is what they hold, and then they start using those $500 billion to use for the government spending.
Yeah.
In the meanwhile, they tried to do something about the ceiling, but they didn't mention to do that. And now it's expected, it's now half May, it's expected that before the end of the month or around the beginning of June, they will really, all the money is gone. And if the money is gone, and I think we saw it years ago, then the government has to make decisions about the spending, and they have to choose to don't pay out certain salaries. So that's we saw it in the news a couple of years ago. Why did it happen this time? The budget for this year already took into consideration a deficit of $1,000 billion. But the income from taxes, mainly from the profit margins of companies, was less than expected, and they are losing more than they have less than $100 billion income out of that. So the deficit was already there. Sometimes there is no deficit in the budget. This time it was already there, but bigger than expected.
At least it was planned, no? As long as it's planned.
Yeah, but not that bad.
Not that, yeah, exactly.
So now the decision has to be made if the debt ceiling will be increased. But Taco, explain us a little bit more who is in charge of that decision.
Yes, because there maybe there's not a problem, no? If everyone says, okay, this is the situation and we're going to solve it. But in the US, maybe you know it, but it's always good to know, the Congress, there's the House of Representatives, and it's dominated by the Republicans. And then the Senate, it's dominated indirectly by the Democrats.
Why indirectly?
Well, actually there are 3 independent votes, but they are more to the Democrats.
You have to deal with the Democrats, no?
Yeah, I think so. I'm not sure what kind of deal, but at least with that situation, they are dominating the Senate. So that means that there is always, I suppose, a kind of discussion, even if one party does agree with the other one, but it's negotiating. So also this time, Biden, the Democrats, he wants to solve this problem, no, to increase the ceiling, so the problem will be solved. But the Republicans,
but he wants to increase it without any change.
Exactly. So the Republicans, maybe they also want it, but they want something in return. So they want deep spending cuts. Yeah, and Biden doesn't want that because, of course, he had also made his promises. So that's actually the discussion now. There needs to be done something, but you need to have the political approval and deals. And as long as there's not a deal, then we are in this situation. So it's very difficult. Also, the debt related to the GDP is now it's a high percentage. So, for example, in 2000, around 2000, it was 60% of the GDP. I think it's not that bad. No, you hear countries nowadays with a lot higher, but actually now it's 121.2%. So, meaning that the debt is also now really, in a relative sense, a big part in this case of the GDP.
So in the last, like, say 22 years, the percentage of that doubled.
Doubled, yeah. So I mean, it's not only an absolute figure we are speaking about. Well, we are actually speaking about a figure that's cost, but relatively, the debt is really getting a big problem. Maybe the positive side, the interest rates that we have a lot of papers this time, but the interest rates on this debt that has been recently increasing a little bit, but historically it's quite low. It was around 1.5, but now it's back to 2.1%. So of course that's also very relevant for what the debt it has its costs, no? And if the costs are high of that debt, it will have a bigger impact on your economy. So, it's historically low, but also increasing. So if the amount is increasing or will be increasing more, then also the debt, the percentage, the interest will increase.
And take that in consideration. Then the Republicans they have an argument, because for next year, for sure, the interest rates are on average higher than this year. So the spending that they have to spend on paying the interest rates is higher. So they have to, if the income part stays the same, they have to do something to cut some spending.
We are used to speak about companies here, no, of course. And if you have a company with high debts, no, and we speak, what will happen with the higher interest rate? You say, okay, but sometimes we don't agree with that they maybe benefit. But if you have high debts, and higher interest rates, it really could be a problem.
You have also information about the total debt, no? What how big it is, the debt regarding...
It's like around 6% of costs. So if we compare it to a company, 6% of their budget is already reserved for interest payments. So that
6%.
I'm not sure, to be honest. I cannot compare it with other countries, but it's a lot of money.
So the total budget of the US, total budget, 6% of that exists out of only paying interest rates.
This interest rates regarding the debt. So, like you said, there is an argument to say, okay, until here and not further.
Yeah, and we also saw that amount, so the 6%, that reflects a certain amount, and that amount that you can for that amount you can do a lot of other things.
A lot of parts of the you told me actually, but it's like 5 or 6 departments could actually be live one year with it.
Okay, so what will happen if there isn't a new debt ceiling? Then of course that will be really a big problem if it's for a long time for the US. It never happened before that they defaulted. They became into default. But what you now see, so what is the chance that the market thinks that it will happen? If you look at the 1 month interest rates and the 3 months interest rates, the 1 month is expected that it still expires before the ceiling is actually
the deadline.
touched. So you see the interest, you see the 1 month. I have to say it with the 1 month treasury rate is dropping, and the 3 months interest rate is going up. And you see, if you see that's going apart, that is the biggest spike ever since 15 years.
It's very important.
So the market takes it into consideration that something will happen.
Can I say something more? Because you told me the 6% of the interest, that's like more than elementary and secondary education, disaster relief, agriculture, science, space programs, foreign aid, natural resources, and environmental protection combined. So if you say that the Republicans have their arguments to say, look, what is this debt thing? But of course, they were also responsible for the debt. It's not only this year. But sorry, this I want to...
No, and I would say something. On the other hand, the market thinks in general that there will be a new debt ceiling. So there will be a deal between the Democrats and the Republicans. If that happens, then we run into another problem that's more important for investors. Then we will run into a liquidity problem. Why? Three things. Since 2022, the Fed is working on quantitative tightening. So that takes money out of the market. We had or have, I don't know, I hope we had, but I think we have a banking problem in the US since March, and the Fed put extra money, provided extra loans into the market, so that came extra money in, brought extra money in. And what I said, so the Treasury General Account is since the beginning of this year and putting extra money into the economy because they are using their $500 billion. On average, we can say that the liquidity for the moment, because one went down and the other one went up, that the liquidity has been rather flat. Okay. But when the debt ceiling will be raised, the Treasury Department will start to bring extra $500 billion into the market, out of the market. That is in combination with still that the Fed is reducing the balance sheet. That would be a negative double whammy for the liquidity, because then it suddenly goes the other way. And now it's still in balance, but then it will go the other way. And what will that mean if there's a liquidity problem for the interest rates? Because there's less money in the market and it's a high chance that interest rates will go up. That's, I think, is a really big problem for investors if interest rates go up.
So not only if the deadline is reached, but
no, that's not that important. I think, and that
probably
is,
it will be solved. But this is the
that
real
will be
problem.
solved, and then they have to
execute
Yeah,
it.
they have to borrow $500 billion.
Yeah.
And then to a combination with the Fed, I think that's going to be a really tight liquidity in the market, and then the interest rates will go up. There's another problem also, and that also makes it really interesting. The Federal Reserve is currently a net seller of those treasuries. Most commercial banks also, because money is going, they expect it out of the market, and even the foreign sector is also not currently buying treasuries. So who is buying those treasuries? I think you have also some information. That's a funny thing. Who owns the debt, the foreign debt of the foreign players in the market? Who owned the debt of the US? Because the people always say, "Oh, the Chinese, they have so much debt," and I think you have information about
the same
that,
page.
Yeah.
Japan is with 1.1 trillion, so that's the biggest.
The biggest, not China.
China second, 859 billion. United Kingdom 668, and number 4, Belgium.
With how much?
331 billion.
So almost half of China's debt is owned by Belgium.
Well, I didn't know it at least. It's a strange situation as well. And number 5, Luxembourg with 318. Well,
so if you compare the 800 something billion dollars of that China holds of the debt of the US in correlation to the 31.4 total, that is not that much.
No.
We can't say the Chinese own all the debt of the US.
It's a very, it's true. Yeah, people say it, but it's not a fact.
Yeah. So who will buy those treasuries? Now, we said, okay, the 3 players in the market that probably won't buy it. So the Fed, the commercial banks, and the foreign sector. So what will happen? So the Fed can decide to buy again, but then it's against their own policy, especially to fight inflation. The US Treasury Department can also issue T-bills, so that are like bonds with a maturity of less than a year. And if the dollar weakens, then also the foreign players like Japan, China, so they also can start buying again. But yeah, will it happen? That is an explanation why the dollar is in the last month probably became weaker against, for example, the euro. So there is a big chance that the interest rates will go up. That's a really big chance. And that the dollar will go down because the US hope, because they don't want their own Fed to buy it again, and also not the commercial banks, almost impossible. So they will probably focus on foreign players, and they will buy it easier when the dollar is lower. So it can be a big pressure on the dollar.
But this is very complicated.
This is quite a technical story, yeah.
No, but it is true. Yeah, it's not only the rumors about a deadline and how it will be solved. Even the threat of this kind of movers, no, with the short term and the longer term interest rates, the impact. I think we cannot really foresee it. I cannot foresee it.
So to summarize, and sorry again that we made it a little bit technical, debt ceiling has been reached, probably will be solved, will be higher. What is the problem then? We run into a liquidity problem because then 500 billion at least dollar of the Treasury General account will be issued again. And what will happen with less liquidity, higher interest rates? Who needs, and the other problem, who needs to buy those instruments? And probably that will be foreign countries, and they will do it easier, faster with a low dollar.
So
Probably high interest rate, low dollars.
Now it sounds simple if you summarize it like this.
And we read a lot about it to make it simple for you. So I think it's good for an investor to know this.
Say yes.
Yeah, and I hope you understand it. I hope you agree. If you don't agree, let us know. We like to have a discussion around it. Thank you for watching. Give us your thumb, and I'll see you next week.
Thank you.